Good morning and welcome to this joint seminar with Beaufort Financial and Herrington Carmichael on Untangling inheritance tax. We're going to spend the next hour talking you through some of the main points that we think that need to be considered when we're talking inheritance tax and planning to avoid it where possible. Hopefully everyone can hear me. The chat box is open. If you have any questions along the line, please put your questions in there. There'll be some time for some questions at the end of each presentation. If I'm able to get this right, this is being recorded. So if there's anything in there that you miss or you want to look at again, we will be sending out a recording of this at the end of the presentation. So, without further ado, I'd like to introduce Tony from Herrington Carmichael, who's going to talk you through inheritance tax from the point of view of a solicitor. Good morning, Tony.
Good morning. Can I have the presentation up, please? Right. Good morning. I hope everybody can hear me. Some of you will know Herrington and Carmichael, some of you may not. We are a full service firm. There are a couple of slides at the beginning telling you a little bit about us, and I'm not going to go through those, but basically we've been around a long time. We are a full service firm and we cover just about every area of law with the exception of crime. As a business, we are, as is increasingly the case, a specialist business. Everybody who is a specialist. For my sins, that's my mugshot. I've been around this world for a little over 40 years now, and I've specialised in dealing with inheritance tax, probate, wills, and that sort of area of work throughout my professional career. Moving to the topic of today's presentation, which as far as I'm concerned is to do with what can you do about these problems? And these are questions that I get asked in a variety of forms at very regular intervals. So the rocky marriage of your offspring, a common cause of problems. There's worry that if they get divorced, the other half will walk off with money that you may have given to your son or daughter. Another common problem, and sadly increasingly so, or well, it depends on your viewpoint, we are seeing far more people who are surviving into adulthood who have suffered from some sort of mental damage and things like Down syndrome, cerebral palsy. When I was a youngster, nobody ever lived past about 18 or 19, whereas nowadays these people are living a long time, and that's wonderful, but it does create problems. Another very common issue is the second marriage. Whilst one wants to make provision for your surviving spouse, you also want to be sure that your own children inherit. And very commonly, your second spouse has exactly the same feeling. Lots of us are worried about what happens if our children, if we go into a care home, and lots of people are asking, is there any way to protect against that? There is also the problem of the son, wife, daughter, whoever, who just cannot keep money. And another increasing problem is the bank of mum and dad. We are helping our children to buy their properties, but worry about what happens if a partner, if the relationship breaks up. And then lastly, of course, the ever perennial question of, can we keep the tax man's hand off it? And is there anything that can be done about this? The answer is that in most cases, judicious use of trusts can offer a solution. Can't every time, but a lot of the time it can. So I suppose the first thing to say is, what is a trust? A lot of people don't understand what a trust is. It's something we talk about a lot, but we don't understand. I've tried to define it fairly simply. So a legal structure under which certain people, who we call the trustees, hold property for the benefit of other people who are called the beneficiaries. In this structure, the trustees are the legal owners of the property, not the beneficiaries. If you hear somebody talking about, I get money from my trust, very often what they're talking about is, yes, they get money from a trust, but it's actually not their money, or the money that they get from it is only a limited release. Beneficiaries can get income from trust or use of trust property. They can't give it away, they can't sell it. Inevitably, there are complex tax rules relating to trusts, and this treatment depends on two factors: how the trust was created and what sort of trust it is. So, looking at the types of trusts, if you read literature which is out in the marketplace, and in particular literature which is issued by, dare I say it, the financial planners of this world, insurance companies and so on, you will find any number of trusts which are talked about: asset protection trusts, life protection trusts. There are all sorts of wonderful names, but these are basically just names for a particular sort of product. In terms of what sorts of trusts there are in this world, there are basically four types of trusts, which I've listed here: bare trusts, life interest trust, discretionary trusts, and handicapped or vulnerable persons trusts. Some people would argue that actually that's too many, and there are only two, and you may understand that as I go through this. So, starting with bare trusts, and the secret to the question I just raised was, was that there aren't necessarily four types, is this: a bare trust is not a true trust. In a bare trust, property is held for the benefit of a minor until he or she attains majority. Legally, at all times, the property actually belongs to the child. Any income or capital gains tax, and any capital gains which are received for that trust, belong to the child and are taxed as part of the child's income or capital gains. If you imagine that most children don't actually have any income, this can be extremely useful because they'll have the maximum allowances and there may well be no tax to pay. This is a very convenient way of passing relatively small sums of money to children without the complexity of a formal trust. This also used to be a very attractive way for parents to pass money to children, but inevitably the taxman spotted this about 35, 40 years ago. And the result is that bare trusts cannot be used for children, for their own children, by parents for their own children. The other thing you really have to watch out for is that the property becomes the property of the child when they attain 18. And if you don't want your child running off and buying a motorbike or something like that, the use of the bare trust can be a problem. As it so happens, I know lots of people who have got bare trusts for their children, and somehow they forget to tell the children about it until they're 22. Strictly speaking, the wrong thing to do, but practically it can be an answer. Life interest trust. This is perhaps the most common trust that we encounter. And under this, the beneficiary has a right to income or use of trust property. It's theirs as of right. And generally speaking, it can't be taken away from them. And the trustees are obliged to ensure that the property is benefiting the beneficiary. Any income is taxed in the hands of the beneficiary. If residential property is owned by a life interest trust and occupied by the beneficiary, then that beneficiary can benefit, or to be more exact, the trustees can benefit from the principal private residence exemption for capital gains tax. It can also sometimes be used to prevent the second home stamp duty liability arising, but care's needed there. Capital gains are taxed in the hands of the trustees. And with all trusts, the trustees only have a limited capital gains tax allowance. Typically, that capital gains tax allowance is 50% of an individual's capital gains allowance. But if there were multiple trusts created by the same person, then that capital gains tax allowance can be reduced further. And the capital gains tax is always paid at the higher rate. So that's 20% on things like shares and unit trusts, but 28% on residential property. The inheritance tax treatment of life interest trusts used to be quite simple, but in 2006, Gordon Brown changed the rules, and it now depends upon if the trust was created in the lifetime or in a will. Moving on, we've got discretionary trusts. These are the trusts that are beloved of tax planners, and of many other people for that matter. Instead of having a beneficiary who has a right to income, you have a whole group of beneficiaries who have no right to anything. All they have is an expectation or hope, and the trustees can pay income or capital to one or more of the beneficiaries. It's very common when we prepare discretionary trusts to name a huge group of people, knowing that unless something goes wrong and perhaps somebody dies at the wrong time, only one or two of that huge group of people will ever benefit. The discretionary trust's highly flexible. Sadly, it is not easy to understand. I have to admit that when I was a young lawyer, it took me 3 or 4 years to really get to understand discretionary trusts. And that means that the task of explaining a discretionary trust to an untrained person is quite complicated. And we do sympathize when you come to us and say, I don't understand the language, or what does this mean? And we will try very hard to explain. Unlike when I was the young lawyer, we told clients, this is it, it's great. Nowadays, we actually give you a fairly detailed explanation. As with the life interest trust, restricted capital gains tax allowance, and you pay at the higher rate. The sting in the tail, or one of the stings in the tail for discretionary trusts, is that income tax is payable at 45%. And a lot of the time when discretionary trusts are structured, we try to avoid having assets that pay income. And this is an area where people like Beaufort can help a great deal, because there are a number of structured investment products that work very well with discretionary trusts. Having said that, any income that is paid to a beneficiary has a tax credit attached to it, and it's a 45% tax credit, so that anything you pay to the beneficiary represents only 55% of the amount that they're entitled to. And this means, again, if you have a beneficiary who's not a taxpayer or is a low rate taxpayer, they may be able to claim back a large chunk of that income tax liability. The other sting in the tail with discretionary trusts is that they are what is called a relevant property trust for the purposes of inheritance tax. I'm not going to talk about that now, I'll mention it later. Then we come to the vulnerable or handicapped persons trust. And whilst I've called this a true trust, as with the Bear Trust, it is arguable that it isn't, and that in fact it is a hybrid trust of the discretionary trust and the life interest trust. These are special trusts for persons subject to disabilities. Successive governments, for as long as I can remember, have accepted that if you have a beneficiary who is subject to disabilities, giving them money may not be a good idea. So they've all governments have for a very long time had different special regimes to ensure that trusts can be set up for people with disabilities which are not subject to the usual tax rules. The basic concept of this sort of trust is always to protect property. One thing that is incredibly useful is that money which is in a suitably set up trust of this sort is sheltered from means testing. So you don't have the situation where if you leave property to your son who has Down syndrome, he loses all his state benefits because of the inheritance if it's in one of these trusts. Within these trusts, the capital income can be treated as belonging to the beneficiary. Sorry, not the capital, it should be capital gains tax. I'm sorry, that's a typing mistake of mine. And that is very useful. The trustees have wide discretion over how to use it, but against that, the trusts can be quite restrictive, and the reward is in the tax benefits that you get. So talking a little bit about inheritance tax, the creation of a bare trust or a vulnerable persons trust is usually a potentially exempt transfer if created in lifetime. In other words, no inheritance tax is payable when you create the trust, but if you die within 7 years, tax may become payable. Creation of a bare trust or a vulnerable persons trust in a will is, as far as inheritance tax is concerned, neutral. The estate is subject to inheritance tax in the normal way, but there's no special inheritance tax applied to that bare trust or that vulnerable persons trust. With life interest trusts, we have a difference. If the life interest trust comes into existence under a will, it's subject to the usual inheritance tax on death. And after that, the underlying capital value is treated as part of the beneficiary's estate and will pay inheritance tax on the death of the beneficiary. I often get people who don't understand this and think that it's unfair. There is an argument that says perhaps it is unfair, but that is the structure that has existed for life interest trusts for a long time. And that will apply, but that will only apply if the life interest trust came into existence under the will. Since 2006, if a life interest trust is created during somebody's lifetime, and sorry, I've got myself slightly confused here. I'm permitted to say, if a life interest trust ends during a beneficiary's life, that's treated as a potentially exempt transfer. So if, for example, I receive the right to income from, shall we say, £500,000, and then after a few years it becomes apparent that I don't need that income, and the trustees have the power to pass that money on to, shall we say, my children, that's treated as a potentially exempt transfer by me to my children. And then moving on to what happens if a life interest trust is created, any other trust which is created by will, whether it's a relevant property, any other trust which is created by will or in lifetime is a relevant property trust. So if in your will you create a discretionary trust, that is a relevant property trust. If you create a trust in your lifetime, that is also a relevant property trust. When the trust comes into existence under a will, inheritance tax is paid in the usual way at death, but thereafter it pays tax every 10 years. if you create a relevant property trust in your lifetime, then tax is payable at the time, or may be payable. The tax which is payable is tax payable at the lifetime rate of 20%. But if you create a lifetime trust and then die within 7 years, the tax on that creation is doubled to 40%. So the creation of lifetime trusts is something which has to be done with extreme care, because it can give rise to some nasty tax shocks. The other thing which I just mentioned and is shown in the last line on this slide is that any relevant property trust is subject to inheritance tax every 10 years. The inheritance tax is charged at the rate of 6% insofar as the value exceeds the nil rate band. And for these purposes, please be careful that the nil rate band is always the basic nil rate band, not any nil rate band that may have been enhanced by the residence nil rate band or by a transferable nil rate band. So currently that is £325,000. So looking at some tax issues with lifetime trusts. When you create a lifetime trust, the taxable value is assessed by reference to other chargeable transfers made within 7 years. I'm sorry, this is incredibly complicated and it is not something that is very easy to explain. Broadly speaking, what it means is that if you want to create a lifetime trust, you need to make sure you get some fairly careful planning on it, and that your financial history is fully disclosed to the financial advisor. Failure to do that could result in some nasty shocks because of the potential lifetime charge to inheritance tax. As mentioned previously, a lifetime trust has a potential liability to inheritance tax every 10 years. I've mentioned the 6% tax. That may seem frightening, but actually there can be considerable advantages in that. If you imagine a trust which carries on for many years and only pays tax at 6% every 10 years, that means the trust will go on for something like 40 years before you've paid the equivalent of the 40% tax that might be charged if you had a life interest trust, and the beneficiary had died during that period. So although the 10-year charge can sound frightening, it actually is not always frightening, and it can be quite a beneficial way of passing property on through several generations. Creating a lifetime trust is a gift for capital gains tax purposes. That's a very important point which unfortunately is often forgotten. With a lifetime trust, sometimes it is possible to hold over capital gains tax. It makes it a bit less painful. And at the end, I've said, please be careful of lifetime asset protection trusts. There are, unfortunately, a lot of people out there who will tell you that if you put your house into an asset protection trust during your lifetime, it's the best thing since sliced bread. It will prevent the house being subject to nursing home fees. It'll save inheritance tax, all sorts of things like that. Unfortunately, in most cases, that advice is wrong, and you've potentially got a trust which doesn't work for any of those purposes, but may still be liable to the inheritance tax liability of 20% and the 10-year charge. It is one of those really nasty, worst solutions. And if you're ever thinking of asset protection trusts being created during your lifetime, think again, or at least make sure that you get some very careful advice on it. But at the same time, please don't be confused. There is nothing wrong with creating a trust of this sort in a will. It's when you create it in your lifetime that the problems arise. So what trust might suit you? It really depends on your agenda. Difficult to give generic advice, but some thoughts. Life interest trusts are simple, particularly if they arise under a will. They will generally protect the estate of the first partner against nursing home fees and a second marriage. They will also preserve your assets for the child of your first marriage. Can be very, very useful. We use these a lot in wills for these purposes. Discretionary trusts can be used particularly to protect children from a rocky marriage. Lifetime trusts, they're fine for protecting gifts to children, but there are complex issues and you need care. The vulnerable persons or discretionary trust can be essential if you have a beneficiary with a disability, but again, there are you need to be very careful of them and need proper advice. Protecting against the taxman. I've mentioned the taxman a lot. Trusts can help, particularly clever use of discretionary trusts or hybrid trusts. But it's a very complicated subject, not something I can really discuss today. Generally, your best bet is to speak to professionals and get advice. Now, I haven't got very much time left, but I've got a few slides on taper relief, which is commonly misunderstood. And I'm going to go through these very quickly, but I'm afraid it will be a quick dash. And the slides, hopefully, which you can get, will give you a bit more information on it. The basic message is taper relief does not work. And the reason is because it tapers the tax, not the gift. I've got an example. Lear gives Cordelia £300,000. It's potentially exempt transfer. He dies after 5 years. It's now what we call a failed pet. Before he died, Lear had told Cordelia that with the 5 years taper relief, the gift would only be worth 180,000 because the taper relief had reduced the gift. Unfortunately, he's wrong. It hasn't reduced the gift, it's reducing the tax. And Lear's estate was worth £1 million. He was eligible for the nil rate band and the residence ban, nil rate band of £175,000. And I've got a worked example. And the end result is there is no saved tax at all on the failed pet because it was less than the nil rate band and no tax was paid on it. It's an unintended result, but it might work. It's something you need to be careful of. Had Lear lived longer, the pet would have succeeded and there would have been a considerable reduction in tax. And just to show that taper relief can work and how it works, we've got a different solution. Here we've got Henry, who gave money to his daughter Elizabeth on the 1st of May and died after 5 years. He had an estate of £1 million. He's got no nil rate band available. When we look at the figures here, we've got tax on the pet, but because there was tax on the pet, because it was more than the nil rate band, we actually get a reduced tax bill because the tax has been tapered by 40%. And that makes the effective rate of tax 24%. And just to mention that if Elizabeth had been the sole beneficiary, it wouldn't make any difference. But if he'd given the rest of his estate to his other daughter, Mary, she would have ended up paying rather more tax than expected. So I've got a moral in the story, which is start your tax planning early, with the alternative moral that do be careful because there can be unintended consequences when you favour one child against another. That's the end of my presentation. I don't know if there are any questions for me.
Tony, yes, we have had one question or a couple of questions come in from Steve Clark, who's asked about agricultural relief from farms and suggesting that there's no IT liability on them. His second question is around shares in unlisted companies. I will answer that, Steve. If you can wait on during my presentation, I'll talk briefly about that. But Tony, if I could ask you to just touch on agricultural land and farm relief.
Right. I mean, the position with regard to agricultural relief is that a farm is eligible currently for 100% relief from inheritance tax, but the Inland Revenue do not like this exemption, and they will fight tooth and nail to deny it if they can. So, for example, if you are a hobby farmer, you may struggle to get it. If you are running livery, you will not get it, or very, very unlikely you'll get it. There may also be limited availability in a number of other cases. So that, for example, they may only make it available on part of the farmland, but not on the farmhouse. So there are lots of limitations, and many people who think that they have farm property that is going to be eligible for relief discover that it isn't. It's an area where a lot of planning is needed if you're going to maintain the relief.
We've also had one more question in from Jane. Is an asset protection trust the same as an asset preservation trust?
Probably is the answer. As I mentioned, there are loads of different names. Generally, what most asset protection or asset preservation trusts are is a life interest trust, normally for the survivor of a husband and wife or of a couple. The ones that I'm cagey about and have said you need very careful advice on is where there's an asset protection trust for the benefit of a husband and wife made during lifetime.
Okay, thanks for that, Tony. I think we'll move on. If you've got any more questions for myself or Tony, at the end of my presentation, we'll take some more questions. Move the presentation on. Sorry about this, just bring up my presentation. There we are. So, my name is Andy Coles. I'm a Chartered Financial Planner at Beaufort. I'm just going to spend a bit of time now going through some options of financial planning and how to start the process of working out what your liability might be for inheritance tax and how best you can manage that the way through. We do not have the same long history as Herrington Carmichael, but we are celebrating this week our 10th anniversary at Beaufort. So I can't. What to do with financial planning and inheritance tax? It's a very, very hard and broad subject to work out what your inheritance tax liability is now, what it might be when you pass away, and what will you spend and earn in that period in between. And of course, with all inheritance tax problems, nobody can tell you when you're going to die. So there is always a little bit in between of understanding getting a perfect plan for inheritance tax versus getting it close enough and making sure you've done enough things to mitigate it as much as possible. First things first, you've really got to understand what all of your assets add up to and what are they likely to do for you over the course of, if you're starting inheritance tax planning at retirement, which a lot of people start thinking about, between the time that you retire and stop earning and making capital until you die, how are you going to use your assets to help you? Because fundamentally, before we start thinking about inheritance tax, we should be thinking of how am I going to spend the money that I've earned and I've made myself, and making sure that you have enough money in your lifetime to do the things you want. So inheritance tax, have that as a thought process, but make sure you know what your assets are able to do for you. Do you have assets that will guarantee you an income for life, so you can plan and know what your income is going to be? Do you know what you're going to spend? The quickest and easiest way of getting rid of an inheritance tax problem is spending money. There's no time frame. As long as you're spending money and it doesn't exist in your estate when you pass away, then there is no inheritance tax to pay. However, you have to balance that with, if I spend everything, what happens if I run out of money? So when you're starting the process of thinking about inheritance tax, make sure you have a good understanding of where you are today, where you might get to in the future, and what you're likely to spend along the way. You also will go through a change in attitude in money as you get to retirement, as you head through retirement and towards the end of your life. People who have inheritance tax problems generally have been very good at saving money. We're all conditioned as employees and workers that at the end of every month, there is money to be spent. Actually, there's money to be saved first before we spend it. We'll pay off our mortgage, we'll put into savings. And again, people who have amassed money will have saved money. So they've been conditioned to save. As you get into retirement, you will have your assets and they will then be used for you to spend. It's not always easy changing that lifestyle from going, what can I spend out of the income I've got left, versus what can I spend out of the capital I have. So understanding your lifestyle and understanding what you want to do with the rest of your life. It sounds a bit corny, but do you have a bucket list yourself? Have you got things that you want to do? Can you do them and spend your money first before you look to give it away? And the other thing that then becomes important is, what are your objectives? What is the meaning of the money for you? Everyone who has lived a full life and has got to the age past 50 has a story behind them. They have experiences and they have conditions and what money and how it is done, how it has actually achieved the things they wanted to in life. So understanding your objectives of what this money should do and what you want it to do after your death is as important as actually understanding what it is. The real simple example, and Tony mentioned the tax man a lot, and it really is true that it is a driver, but fundamentally an objective isn't, I don't want to pay any tax. Because you can achieve that very simply by writing out a cheque for £250 to every single person that you pass in the street. Okay, it would be hard during COVID, but in normal circumstances, if you write a cheque to everyone just before you die, then you won't pay any tax. But it's unlikely to achieve your objective of helping your children, helping your grandchildren, or passing it on to elsewhere. So when it comes to inheritance tax, having a good understanding of what your objectives are with the money will help you as you go through and start spending and start potentially gifting it away. We as financial planners talk about what is my number. So what that means is, how much money do you need in your lifetime to ensure you have enough money to do what you want to do? So using a cash flow modeling tool that we do at Beaufort, we will show you what you've got today and what are you likely to spend during your lifetime, and how are you going to get to a position that you need to get to over the course of your lifetime. Once you know that, you will be able to see, given an estimate on roughly what you're going to spend in your lifetime, is how much tax you're likely to spend on your death. Again, it's an estimate because we don't know the colour of government when you're going to pass away, so we don't know what the rules will be at that time. We also don't know the time of your death either. So getting yourself into a position to understand what your income will be, what will never change is income. If you have a final salary pension and your state pension, well, that will always be there for you. So you can start planning and knowing I've got some secure income. If you're reliant on ISA portfolios or pensions or second properties, income from them can vary and it can change. You have to be a little bit more careful of understanding where my income needs will be. Again, expenditure. To quote the Red Hot Chili Peppers, this life is more than just a read-through. We only get one go at this. So making sure that you achieve everything that you want during your time is as important as understanding what you want to do with the money after potentially you're not here. So you also have to be aware of your change in expenditure. Tony mentioned very briefly care home fees. It is an unknown at this moment in time what you're likely to have to spend on care home fees as you go through life. At the end, we've had a number of reports. The Dilnot report a few years ago did come up with some good ideas, but is yet to be taken up by the government. So again, making sure you understand that is important. I want to ask 3 simple questions now. So if everyone could just have a think about, if I offered you £50 today or £60 tomorrow, what would you choose? In that example, I think everyone listening to this call would say, thank you very much, I'll have £60 tomorrow, because to wait one day to take an extra 20%, thank you very much, I will take that straight away. That sounds lovely. The second one, would you like £1,000 today or £2,000 a year in 5 years' time? That's in very simple terms, that is an investment return of 14% a year in 5 years' time. So initially, you might very well think, fantastic, that's a very nice return. I'll take £2,000 in 5 years' time. But understanding the value of money to you, you may choose £1,000. I have a client who I saw in December on an annual review, who we were talking through what has he done this year. And he said he'd spent £1,000 and was able to, for the first time, to tick off his bucket list, fly on a Spitfire. He just retired. He was 68. The £1,000 he described as the best £1,000 he's ever spent in his life, because it really was the one thing he had left to do and wanted to do in retirement. If he had waited 5 years, Spitfire might not be flying in 5 years. He may not have been fit enough to do it. So for him, the value of the money today was far more important than what it might have been in 5 years' time. And the last example, would you like £30,000 today or £60,000 in 20 years' time? 20 years' time could very comfortably be an average average length of retirement. So is £30,000 more useful for you now or when you retire? Or sorry, in 20 years' time, you may not need it. You may not want it. So understanding the value of that, but also start thinking about, you're thinking about inheritance tax, by definition, you're thinking about passing money forward to the next generation. What is £30,000 today worth to somebody, your children, your grandchildren, compared to what it is £60,000 worth to them in 20 years' time? What someone could do, if you pass money down immediately now to someone, a child or a grandchild, to purchase a house, that £30,000 in 20 years could become £240,000 by doing and having exactly the same growth rate as the £30,000 to £60,000 that I've just mentioned. Now, it's not perfect, and there's some caveats, obviously, but if your children or your grandchildren use that money as a deposit for a house, well, they are what's known as gearing an investment. So they're taking some risk, and the growth is massively increased by the fact that £30,000 go in, but if they buy a property worth £120,000, in those 20 years pay off the mortgage, and the growth is still 3.5%, you get to £240,000. So when inheritance tax is being thought about, think about the benefit that the money that you're thinking of trying to take away from the tax man, what benefit can it do for the people that you're trying to help? And of course, if you take it one step back, and if I just quickly go back to £30,000 now versus £60,000 in the future, if you are over your current nil rate bands for inheritance tax, 20 years of growth at 3.5%. If you get to £60,000 in 20 years' time and you pass away and it's still within your estate, that £60,000 becomes £36,000 after the taxman has taken his 40%. So, in summary, when you're looking at why should inheritance tax become important earlier, well, what can the money do for other people? Have you secured the lifestyle that you want to do first? If you've done that, how can it help other people? How do we invest, and how can you invest with inheritance tax in mind? So after you've got through your objectives, you understand what you're trying to achieve, you understand what you need yourself, what your number is for the rest of your life, you can then start thinking about how do we start creating a plan to ensure that we can get the money in the most effective manner to the people that we want to do it and how we want to get it done. So we've spoken a little about how you can achieve it. Your attitude to risk. Again, as you go through life, this will change. As you've created income and you've created wealth, you've been looking for returns to ensure that you can retire in the manner that you want to do. The attitude to investment risk and the attitude to risk has two new added risks that people don't think about when we come to planning for inheritance tax. If you are holding excess cash in your portfolios or just purely in the bank, well, you've got the risk of inflation eating that away. And of course, with inheritance tax, you've got a tax risk as well. So if you do nothing, over time, you're going to have inflation eating away at the real value of the money. And then at the end, there's going to be a tax in there. So attitude to risk and how you want to set up your assets has a few more facets to it when it comes to inheritance tax risk, and we're looking at time. After listening to Tony describe so well of how you can use trust to protect and control things, I'm not going to go into too many details in here. But what I would say is using trust can be a wonderful way of controlling things. And all of the things that Tony mentioned, you can use trusts and make sure you do it. But until you understand what you're looking to achieve and how you're able to do that, it's very hard to actually go through those things. There are a number of simple first steps that you're able to start looking at and getting the basics right. Everyone has a £3,000 a year exemption. So you can give away £3,000. If you're a couple, that gives you £6,000. You're also able to go back 1 year. So if you haven't used your exemption from the previous tax year, you can use them as well. So in 1 year, you can give away, or the first year of doing this, you can give away £6,000, or as a couple, £12,000 immediately. If your son or daughter are getting married, £5,000. If it's grandchildren, £2,500 to do that. There is a little known exemption of gifts out of excess income that you can give away all of your wealth without having to wait 7 years as a gift if it's coming out of excess income. If you can prove that the income that you're receiving isn't detrimental to your it's excess and it's not detrimental to your lifestyle, you can give away that for free without having to wait 7 years. You have to be a little bit careful because you have to record that properly, but that is fine. I've mentioned them briefly before. You can give to anyone £250. So if you wanted to on your deathbed, you could start writing checks to anyone you can see in front of you. It will reduce your bill, but does it really fit with the objective you're trying to have with your inheritance tax planning? The single most important thing that anyone thinking about inheritance tax planning must ensure that not only do they have a will, but it's up to date and it's going to be able to do what they want to do it. A will is not like a driving test. It's not a case of getting it once and going, I've got that, let's go away. You have to you have to make sure that the will is going to get the money to the people that you wanted to in the most efficient way. And if you did it 15 years ago, it may not be what you want to do now, but it also, the rules of on death have changed, and how you set up the will may well have changed. So always make sure you've done that. Lasting power of attorneys are also another important thing. You will start a process of inheritance tax planning. There is no silver bullet. There is no one thing that will do it and go, I've done inheritance tax, I never have to think about it again. It will always be a gradual process, and even if you do make some big steps, there will always be some things that you might need to do. If unfortunately you're unable to make decisions for yourself, are your attorneys aware of what you've done and ensuring that, if possible, and there are some limitations, they can continue what you're doing? Also, ensuring that your existing pensions and investment portfolios are geared up to be doing what they need to do for you now, not what they were meant to be doing for you 15, 20 years ago. Once you've got your mindset right and all of that, we can then start talking and thinking about solutions. But it's only at that point, when you understand the starting points for you, your objectives, your situation, what you really want to achieve, and how you might want to go about it, you can start overlaying things and overlaying solutions to these problems. And between a good solicitor like Tony and ourselves as financial planners, we can make sure that you're in the right areas that are going to suit you. They're going to make sure that what you're trying to achieve, you're able to do it. For an example, you can see in there an offshore bond. An offshore bond is just a tax product that you're able to do certain things with. As Tony mentioned, grandchildren have their own personal allowances for tax. So if you were a grandparent and you were looking to fund school fees or university potentially for grandchildren, using a product like that can be a really useful and tax efficient way of getting money across to people. So there are lots of things that you're able to look at and talk through on this. So gifting to charity is possible. My view on gifting to charity, a lot of people look to gift money to charity in their will. By definition, if you're doing that, you are probably a nice person. If you're giving it away in your will, is it possible you can give some during your lifetime? Because if you do, it's likely that you'll get a personal benefit. It'll increase your personal well-being for seeing your money going to things that you have a passion for, you want to help. Now, it's a lovely gesture doing it all in your will, but if in your lifetime you can do some as well, then that's something that I think is a positive thing, and we should try and do if you can. I'm just going to go through a couple of the examples in there and some things that you can do. Gifting is the simplest thing you can do. You have to survive 7 years. You do lose complete control over the asset if you do it. But if you do last 7 years, it's nice and simple in doing that. Again, you have to make sure, because you've lost control, that you can afford it. But simplest and a very useful way of doing it. Trusts. Tony has given you a very comprehensive guide of how and when to use trusts. There are a couple of downsides to them, but there's some really good planning. It allows some control. If it's your children you don't trust and you're trying to look after your grandchildren, a trust can be a really useful thing. Loads of really good things. It is more complicated than gifting, and it does potentially involve more tax than gifting. But it still comes under the same 7-year rule, and it will get the money outside of your estate while you remain in with some control to it. Life assurance is another way of helping with an inheritance tax issue. Personally, I feel it is just a pre-funding of it. You are going to take out a policy on yourself. So if you're a couple on second death, there will be a lump sum payment that will come out outside of your estate that should be able to pay any inheritance tax for your beneficiaries. It's more of a pre-fund than a fix. So you're taking money out of your estate every month, paying for a policy that will pay the bill at the end. Now, unfortunately, we don't know the time of your death, so you don't know how long this policy is going to, or how much it's going to cost you. And you also, again, you don't know the colour of the government that's going to be in on your death, so it's very hard to know what the final bill will be. I think it's safe to say that Jeremy Corbyn and Boris Johnson would have a very different views of what inheritance tax should be. So if you start a policy today and you have 20 years life expectancy left, it's very hard to know what you're trying to protect, or you're trying to get a figure to pay a bill that it could be anything. So with caution, they can solve some problems, but it's not something that will be a perfect solution, I wouldn't have thought. Business property relief. This is what Steve Clark mentioned in his question earlier. Back in the 1970s, the government introduced what we now know as business property relief, or business relief as it is now officially known. And it is effectively, if you can think of it in very simple terms, the reason why we have Baker and Son, the bakers in the high street, and Fish and Daughter, the fishmongers in the high street as well. It allows you to pass property from one generation to the next without suffering inheritance tax. If Baker and Son, the bakers, had to pay inheritance tax on death of the father or mother, then it's likely that the shop would close. The shop would close, the employees would not be paying. It changes the society and it costs the government money. So the government decided, we're quite happy for you to pass on business assets to, at the time, children, to allow business to continue. Over the course of the last 15, 20 years, they have extended the rules, and you are now, most unlisted companies, and also most companies on the AIM stock market, which is the stock market below the FTSE. Lots of caveats, and you've got to be very careful on the actual definition of what qualifies as business relief and what doesn't. But in very simple terms, if you hold the asset on death and you've held it for 2 of the last 5 years, or an asset in a business relief qualifying asset, then the asset is classed as a 0 rated for inheritance tax purposes. Very important definition, very technical, but it is still within your estate, but on that asset you will pay nothing for inheritance tax. It does have some consequences with the relatively new residence nil rate band. Not something I'm going to expand on today, but just be aware that it is nil rated for inheritance tax, not tax-free and not outside of your estate. So yes, they are assets that you can do, and again, you have to bring yourself back into what your attitude to risk is. Generally smaller, less well known, and with less assets involved in the company, you're taking more risk while investing in these companies. Potential for big growth, potential for a lot of loss involved. So understanding this and understanding that they may not be as liquid as you like them to be is an important way of investing. One advantage of it, though, it still remains your money. So if you ever were to run short of money, you could theoretically be able to get hold of these assets and use them for yourself. My last slide today is really just going to talk about why take advice. Well, if you've understood everything that myself and Tony have spoken about today and you know all of it, you can do all of this yourself. However, taking professional advice of people who will understand your personal circumstances, your objectives and your needs, once you have that, we're able then to put a plan together and help you manage your way through it. As I said earlier, it's very, very unlikely that you'll be able to find a silver bullet that will solve all your inheritance tax problems in one go. So it's likely to be a progression. Your planning for inheritance tax might be very different when you're 60 than when you're at 80. At 60, you've still got a long time that you may want to spend a lot of money. As you get into your 80s and older, your expenditure tends to reduce a lot. So you can be far more aggressive at 80 than you are at 60. So taking advice and looking at a holistic approach of all of your assets, what you're trying to achieve, and doing this over an extended period of time will allow you to mitigate inheritance tax as much as possible, but also make the most of the decisions you're making, not only for yourself, but also for your beneficiaries. So that's the end of my presentation today. I have seen a few questions come up. So just take them in the order that I can see them. Shona has asked a £250 to the same person over and over again. You can only give £250 to a person once a year. So the £250 is an annual exemption. Helen has asked, gifting, how much can you gift to a son or daughter per year? So there is not, if you are going over £250, then that brings you into the £3,000 a year, which you're entitled to give away. So you're entitled to £3,000 to give away. In very simple terms, if you've got a son and a daughter, of that £3,000, you could give £1,500 to each of them. And is it possible to ensure? And then, yes. So, Anne, just very quickly, as an insure, you can insure a gift. It's technically known as a gift inter vivos. So it's an insurance policy that will reduce over time as the gift potentially does on the taper. So yes, you can. If you make a large gift and you want to say, well, I will pay the tax for you, or you can insure my life that if I die within the 7 years, you can. So yes, it is possible to do that. Let's do an actual case where so I'm just reading Anne's question again to make sure. Yes, and just very quickly, I will ask Graham to give you a call and just to go through all of that on the case offline as opposed to go on with everyone else. That's okay.
Andy, may I interject slightly?
Of course.
The question about the £250, it's a very funny little relief, this one. And Andy said you can't make multiple gifts to the same person. It actually goes a little further than that. You can't give the annual 3,000 plus 250 to one person. Has to be a different person. It's a very funny little rule. That why it's quite like that, I do not know, but that's the way the rules are set up.
So yeah, thanks for that, Tony. As I can't see any more questions coming through, I think we'll wrap up the webinar today. Thank you very much for attending. Hopefully you found it useful. Hopefully you've got some more questions that you can go away and have a think about it. Myself and Tony and all the people at Herrington and Carmichael and all the people at Beaufort Financial will be more than happy to ask any questions. We will send out the slides for everyone today, and there will also be a recording if you want to listen to back to anything else. Then yes, we're very pleased and happy that you all came along today and listened to us. Thank you.